Good evening, everyone. Welcome back to Corporate Tax Webinar Series Part 2 by RBS Auditors. I am your host, Chinju Sebi. In this session, we are discussing about decoding of Freezone taxability. It is one of the most important decisions released by the authority via Cabinet Ministerial Decision 139 and Cabinet Decision 55. Today, we are going to discuss some of the important parts of the session. Before going to this session, we hope you enjoyed our first part. It's regarding the basic concept of corporate tax. We have uploaded the entire session in our YouTube channel. So please do subscribe and post your valuable comments over. Your doubts and questions are highly welcomed and appreciated. We will clarify them at the end of the session. Now I invite Mr. Sujin Keravi for the session. Thank you.
Thank you, Chinju. Ladies and gentlemen, good morning, good afternoon, good evening. It's my pleasure to discuss decoding of Freezone taxability. Thank you for joining our second webinar series. We are dive into different aspects of Freezone. It is relating to taxability, tax points, then what are the Freezone it will be applicable. All these points we'll be discussing. In the first webinar series, we have already discussed about the POEM. That means a place of effective management, place of establishment, permanent establishment, residential status, and other non-residential status, then computation of taxable income. So first webinar series, we have covered all these things, including BEPS action point 1, pillar 2, and what are the rates. These things are already discussed in the webinar 1 series. And some of the areas we have to understand that concept in order to understand the Freezone taxability. So our agenda for today mainly relating to Freezone definition, designated Freezone, qualifying Freezone person, qualifying activity, excluded activity. Then we'll discuss de minimis. Then some of the areas relating to some problems. Then we'll sort out. So let us see the Freezone area. So in UAE, we have a different type of Freezone. One is relating to designated Freezone, then other one is relating to non-designated Freezone. So designated Freezone means you have a custom borders, like each area wise. If you want a movement of people or movement of material or goods, it's only through checkpoint. So that's why it is called a designated Freezone. And the other Freezone, it is like not having any checkpoints, like for example, DMCC, then DSO. These are the other Freezones category. So each Freezone having its own rules and regulations, then its own activity. So some Freezone you can take some activity, some Freezone you cannot take some activity. Now let us look at the overview, entire overview of the taxability, Cabinet Decision number 55 and Ministerial Decision number 139. We'll look into the major areas one by one. One consideration we have to see TP requirement, transfer pricing documentation requirement, whether it will applicable for mainland companies, mainland transaction or international transaction. Usually TP requirement, it will be applicable for related party between the international transaction, but relating to UAE related matters, it will be including mainland transaction. We'll discuss this in further areas. Then another thing we have to see the VAT consideration. As per qualifying Freezone, VAT is defined as per qualifying Freezone. So in CT also, it is specifically says that it's Freezone must be as per VAT law. It's not as per CT law, it's as per VAT law. Then we'll discuss some areas relating to participation exemption. Participation exemption means a 5% interest in the other company. That means either 5% or 4 million investment, then it is treated as participation exemption. Then we'll look into some of the areas relating to BEPS consideration. That means there are pillar 1, pillar 2, and in pillar 2, there are 2 categories. That is globe rate, globe rules, and the second one is STTER. These things we have already discussed in the first webinar series. So in globe rules, the minimum tax liability is 15%. That one, it will be included if your turnover, MNC companies, if your turnover is more than 750 million euros. Then next category, qualifying group. Qualifying group consideration, there is, you will not get any loss transfer within the qualifying group. Then restructuring a business, in that one there is no business restructuring. Then CT grouping is not possible for qualifying free zone. Then no small business, that means you will not get any small business relief. So then these are the qualifying free zone means. A free zone person must be a resident person. Then we'll look into some of the areas of free zone concept, qualifying free zone concept, what constitute qualifying free zone concept. Then qualifying income 0% for corporate tax, then non-qualifying income, then excluded activity. So we'll look into taxability matter. So income from qualifying activity in a free zone, it will be taxable at a 0%, that including transaction with other free zone. We will look in detail one by one. Then income from a domestic permanent establishment in mainland or in foreign country, that will be taxed at a 9%. This also we'll discuss in detail in our following slides. And another thing, whatever the transaction you are operating in the qualified free zone, it must be operated only through the juridical person. Then if it is not a juridical person, then the tax liability will be the 9% that we will discuss in detail. So as per Article 1, free zone means a designated and defined geographical area. That means it's a designated free zone. Then free zone person means a juridical person. So whatever the free zone selected for that purpose, same treatment is given for city also. So for example, in the previous slide itself, for definition area, if you see the free zone person, it's a clearly mentioned of a juridical person. So that case, natural person or unincorporated partnership or sole establishment, you will not get any 0% tax on the whatever the income earned in that free zone. That means automatically, if it is an establishment, then automatically charged at a 9%. There are some exceptions that we will discuss in later. So juridical person means any company, public or private, PJSC or LLC or LLP or FZC or FZ LLC. So whatever the forms in a different free zone having a different forms, and that will be treated as a juridical person, including a branch of a foreign company or domestic free zone person will be also treated as a juridical person. So main condition, it is a juridical person. Now let us look at a designated free zone. So for example, Abu Dhabi, we have a free trade zone Khalifa Port that will be treated as a designated. Khalifa Industrial Zone, Al Butain International Airport Free Zone, Abu Dhabi Airport Free Zone, Alain International Airport Free Zone. If it is in Dubai, Jebel Ali Free Zone North and South, Dubai Textile City, Dubai Aviation City, International Humanitarian City, Jebel Ali, Dubai Cars and Automotive Zone, then free zone area in Al Quds and Al Qizais, then Dubai Airport Free Zone, and Sharjah Hamria Free Zone, Sharjah Airport International Free Zone. Ajman Free Zone, Umm Free Trade Zone in Al Ahmad bin Rashid Port, RAK Free Trade Zone, RAK Airport Free Zone, RAK Maritime City Free Zone, Fujairah Free Zone, then Fujairah Oil Industry Zone. Now, Article 18, it's defined about the qualifying free zone. So what are the qualifying free zone? In order to consider it as a qualifying free zone, you have to strictly follow 6 points. One is maintain adequate substance in UAE. That means adequate asset, adequate staff, then adequate expenditure to be incurred relating to core income generating activity. So it is basically it's similar to ESR. ESR we are discussing about the core income generating activity. Similar way in qualifying free zone, one condition relating to maintenance of adequate full-time qualified employee. Second one is relating to expenditure. Then third one is relating to assets. So this condition must be followed. But one assumption, it is relating to ESR. It specifically says about there is no reference for board meeting in UAE. ESR, it's required for a board meeting in UAE, but in CT it is not mentioned. And second condition, it's relating to outsourcing. You can do outsourcing in the free zone, not in any UAE, not in any other places. So if you are outsourcing your core income generating activity, then you can do within the free zone itself. Second one is a derives qualifying income. Derives qualifying income means income derived from the qualifying activity. We will be discussing in detail relating to what are the qualifying activity. Then not elected for CT at 9%, not elected for CT. That means you have an option. Either you select for ET at 9%, CT at 9%. That means I have some transaction. It is not related to qualifying activity. So I straight away I'll elect as I will pay with the 9%. In that case, you will get whatever the deduction, 375,000 deduction, whatever the relief, then the group adjustment, everything you will get. If you are not elected, then only the qualifying reason. So there is an option, either you can elect or not elect. If you elect, then you will not get the qualifying reason, 0% you will not get. If you are not elected, then you will get. And fourth point, it is relating to arm's length principle. You have to follow arm's length principle in relating to transfer pricing. In that, you have to maintain Article 34, and documentation, it's relating to Article 55. There are 5 methods of arm's length price as prescribed by OECD. Comparable cup method, comparable uncontrollable price methods, then cost plus method, then resale price method, transaction net margin method, profit split method. All these 5 methods are there. These methods must be followed whatever the transaction you are interacting with your related party or mainland. Why it is a mainland? For example, you have a tax liability at a 0% in the qualifying free zone. If it is in a mainland, it is a 9%. So in order to avoid the tax, you can shift your entire business from the mainland to free zone. That is possible. So in order to avoid this one, they have clearly mentioned transfer pricing documentation you have to follow. That means whatever the pricing, it must be based on transfer pricing. That's why this condition is already put and clearly mentioned that if it is a branch, then it is a 9%. We have already discussed in the first place. And if it is other category, we will be discussing in detail the next slides. And another condition, audited financial statement. You have to maintain audited financial statement. If it is in a mainland, there is a condition that a revenue exceeds 50 million, then only you have to maintain 50 million, then only you have to maintain audited financial statement. But for a qualifying free zone, there is no limit. Straight away, even if revenue is 0, then still you have to maintain audited financial statement. Then last one is a non-qualifying revenue do not exceed de minimis requirement, that we will explain in details. So these are the 6 conditions you have to follow in order to qualifying as a free zone person, in order to get 0% tax liability. If any one of these conditions are not met in the free zone, then you will not be qualified as a qualifying free zone. So what will be the impact? If you are one of the 6 condition, one of the condition is not met by the company, then you will automatically treated as a non-qualifying free zone. Then you will be charged at a 9%. If you charge at a 9%, you will not able to get any deduction, standard deduction. That means up to 375,000, 0%. Above 375,000, it's a 9%. That standard deduction you will not get. So you have to, before selecting, you become a qualifying free zone, you should be 100% sure that all these conditions you are maintained, then only. For example, you have a company, you have a turnover of 500 million in a sales turnover, and you don't have any employees registered in the free zone. All operations are done from your related party outside the free zone, then it is not possible. Or some of the people are situated in other country in a related party location, and you are operating entire operation from here. In that case also, it will not count it as a qualifying free zone. That's why maintain adequate substance in UAE. So it is more or less similar to ESR. So next one, it is relating to branch. So for example, you have a company situated in a qualifying free zone, a designated free zone area, and you have a branch in mainland. Then whatever the transaction you are interacting between the branch and mainland company, it will be taxed at 9%, not at 0%. But still you will qualify as a 0% CT rate. It is not a excluded activity. It will be still qualify as a 0% CT rate, but the only condition that whatever the transaction happened between branch and the main company, free zone company, it will be taxed at 9%. Then passive income. Passive income means interest, royalty, dividend received from mainland companies. For example, you have a company situated in mainland, you don't have any mainland branch, but whatever the income received, passive income received based on the shares in the mainland UAE company, in that cases also, that will be taxed, passive income will be taxed, you will be eligible for 0% CT rate. So this will be 0% CT rate. We will be coming to some of the problems in that one. You will get an idea about how it is happened. Third one, it is relating to group companies. So for example, you have a company situated in a designated free zone, and you have a company in a mainland company. ABC company is situated in a mainland company. So whatever the transaction between designated free zone and mainland company, for example, it's a subsidiary. If it is a branch, straight away it's a 9%. If it is a subsidiary, you are doing some transaction between designated free zone and mainland company. In that case, still you will qualify as a 0% CT regime. But in case of a mainland company, whatever the payment made to the free zone person will be disallowed. That will not be treated as a deductible expenditure. For example, a company A situated in a free zone company, designated free zone, company B situated in mainland, you have entered a transaction, sale transaction of 1 million to company B. Then that 1 million, whatever the purchases done by company B, will not be deducted in B's books, will not be deducted as an expenditure. Usually, if it is on a purchases, automatically you will get an deduction. But in this case, you will not get any deduction. So straight away, in effect, you will be charged at a 9% corporate tax. So what is previously I have discussed election to subject to CT. Election means it's not relating to the normal election. It is you can give an option. Either you will select a 0% or you can select a 9%. So depending upon, we have already discussed about a 9 category. If you follow all these 9 category, then you can straight away you can qualify as a qualifying free zone. Otherwise, you cannot qualify as a qualifying free zone. Then you can give an application. So what is the difference between if you are not electing to CT at a 9%? What is the difference? If you are not electing CT at a 9%, whatever the income received, income in the sense the net profit, whatever the taxable income after sales less expenses and whatever the income received, that will be straight away 9% tax you have to pay. You will not get a deduction. If you are electing as a 9% corporate tax, then whatever the income it's received, less standard deduction 375, then balance you have to pay 9% corporate tax. So that is the difference. So if you are elected in the first place, you can from the commencement of the tax period in which election is made. That means, for example, you are given on January, then that period, that's taxable year will be treated as that election. And if it is for, you can give an application to the authority that next year onwards, commencement of tax period, then it's a following tax period. So we'll look at again what are the qualifying free zone persons. So you have to follow. One is a substance in UAE, that educate people, educate full-time qualified people. Then second one is educate asset. Then third one is you must incur revenue. You must incur expenditure relating to core income generating activity. Second one derives qualifying income. Qualifying income in the sense, whatever the income received from the qualifying activity, that we will discuss in details relating to that one. Third one, you are not elected for CT at 9%. Then fourth one complies with the arm's length principle. That means a 5 principle. That one you have to do. Then fifth one, audited financial statement. Then Non-qualifying revenue do not exceed de minimis requirement, that we will discuss in detail relating to that one. So if a sixth condition, if you follow, then a CT will be taxed at 0%, and you will be treated as a qualifying free zone person, and your qualifying free zone income will be taxed at 0%. If any of these condition, it's not any of these conditions, one of the condition, if you are not fails to meet, then automatically what is the impact means, you will be ceased to be a qualifying free zone from that financial year plus next to 4 years. That means in effect you will be blocked for 5 tax periods. So you have to pay tax based on 9% straight away without having any benefit. Now we look at a qualifying activity. Qualifying activity, there are two categories, whatever the activity, manufacturing and processing. One is relating to manufacturing and processing. So manufacturing of a goods or material, to promote the manufacturing business in UAE, so they have given qualifying act. One of the qualifying activities are relating to manufacturing of a goods or material. And second category, it is relating to processing of a goods or material. And one condition it is that in order to claim 0% qualifying fees on 0% CT on this one, all these transactions must be carried out on a wholesale basis. That means it's a B2B transaction. It's not B2C transaction, not to the end user. If you are doing with the end user, then automatically it will be charged at 9%. And the second category, it's only to juridical person. So for example, you have a company in a designated free zone, you are interacting with a non-juridical person. For example, free zone establishment, it is treated as a not treated as a juridical person as per corporate tax, and VAT also same thing. So in that case, the qualifying income will not be treated as qualifying activity. The other areas, one is a shares, holding of a shares and other securities, ships. In that case, ownership, management, and operation of ship. Reinsurance, reinsurance services that are subject to regulation. That means a regulatory oversight of the competent authority. Then fund management services that are subject to regulation. Wealth management, wealth and investment management services that are subject to regulation. Then headquarters services related to related party. So next one is a treasury and financing services to related party. Financing and leasing of aircraft, including engine and rotable components, and any other ancillary services, whatever we have mentioned, A to I. Then another category, qualifying activity, distribution of goods or material. So distribution of goods or material in or from designated zone to a customer, resell such goods or material or part, then it will be treated as a qualifying activity. Second category, it is a logistics services. So logistics services, then distribution of goods or material also will be treated as a qualifying activity. Only one condition is that it must be in and out only through designated free zone. So these are the 13 activity, whatever I have just now discussed. And now let us look at excluded activity. So excluded activity means activity that would disqualify a free zone person. So in that category, any transaction with a natural person, other than the following, one is relating to ownership, management, and operation of ships, then fund management services, wealth and investment management services, financing and leasing aircraft. So if you see the previous one, relating to fund management, wealth management, these services to the natural, except these services will be any transaction if you are doing with the natural person, automatically it will disqualify. Then banking activity that are subject to regulation. So if banking activity also, it's a excluded activity. So in case banks, wherever your banks are situated, either in the free zone or in the mainland, the operation of business is similar. There is no difference between the free zone and non-free zone. So automatically banking business, it is excluded activity. If it is a foreign branch, then emirates level taxation, it will be applicable at a rate of 20%. If it is a foreign branch, other cases automatically normal one. and this will be taxed at 9%. And insurance activity other than reinsurance. For example, if you see the previous one, qualifying activity, the insurance, they specifically says about reinsurance services that are subject to regulation. But here, excluded activity, it is relating to insurance other than reinsurance. Then financing and leasing activity other than intra-group treasury and leasing subject to regulation. Then intellectual property, commercial property that we will discuss in detail, ownership and exploitation of intellectual property. So these are the excluded activity which disqualify a qualifying free zone from free zone tax regime. So what will be the impact? If it is a disqualified, straight away you have to pay 9% corporate tax. Now let us look at the comparison with the ESR. ESR, there are 9 category. One is relating to banking business. Second one is relating to insurance business. Third one is investment fund management business, lease business, holding company, headquarters, shipping, intellectual property, distribution and service center business. If you compare with ET, there is an excluded activity, banking business, it's an excluded activity. Insurance or reinsurance. Insurance is an excluded activity. Reinsurance is a qualifying activity. Investment fund management, qualifying activity. Lease finance business, qualifying and excluded activity. Holding company, qualifying activity. Head office business, qualifying activity. Shipping business, qualifying activity. Intellectual property business, excluded activity. Distribution and service center business, excluded activity. So CT, whatever they have done, it's more or less a ditto copy of ESR. That activity they have taken into the CT, then they have bifurcated into excluded activity and qualifying activity. That basis it has taken. If what happens if a qualifying free zone person earns income that is not a qualifying income, that means excluded activity. So what will be the impact? So where revenue derived from excluded activity. So if revenue derived from excluded activity exceed de minimis we will discuss in detail, then automatically qualification will be 9%, disqualify, and person has to pay 9% corporate tax. Now qualifying income. Qualifying income, that means the following categories of income that are not attributable to domestic permanent establishment. Domestic permanent establishment for the purpose of corporate tax means the establishment not having a separate legal entity. So branch is treated as not having a separate legal entity. Anywhere in the world, it must be consolidated along with the head office. Head office in the sense a holding company or whatever the legal structure. So any income from which are attributable for the domestic permanent establishment or foreign permanent establishment, or income from immovable property. Income from immovable property we'll discuss in details. So the following category will be treated as a qualifying income. One is income derived from transaction with other free zone person except for excluded activity. So simple meaning means whatever the income received from a qualifying activity, that will be treated as a qualifying income. Second category, income derived from transaction with a non-free zone person, but only in respect of qualifying activity. Non-free zone person means the person who is not situated in the designated free zone. That means in mainland companies. So in that case, whatever the transaction between the qualifying activity, still you will be treated as a 0%. Then any other income provided, qualifying free zone person satisfy de minimis. So one is relating to you are transacting between the free zone person, any free zone person, not relating to excluded activity. Then other category, non-free zone person, but relating to qualifying activity. Then other income de minimis rules. So beneficial recipient means the end user of the items, goods or materials. Next one, income derived from a transaction with other free zone person. For example, we are discussing about the designated free zone. So you are interacting with other free zone other than designated free zone, whether it will qualify as a qualifying income. So it's the ministry has already issued FAQ relating to this one. In that one, it's clearly mentioned that even if you are in you are transacting with the other free zone, still you will qualify as a it will be treated as a qualifying income. So what are the condition? Income derived from another free zone other than excluded. Again, it will be other than excluded activity, unless other free zone person is a not beneficial recipient of the relevant transaction. That means whatever the material you are transacting with the other free zone person, it must be for other resale or sale to another person. Irrespective of other free zone person can benefit from free zone CT regime or not. So whether the other free zone person, whether he will benefit for this qualifying free zone or not, you will get the qualifying income category. Income from domestic P. Domestic P means a branch. So whatever the income received from domestic P or foreign P shall be considered as a taxable income. Straight away, it will be taxed at 9%. So this will be calculation. Above entity will be same as a separate independent person. That basis it will be taxable. And income from immovable property located in a free zone. So for example, transaction with a non-free zone persons. You have an immovable property situated in a designated free zone, but your transaction between a non-free zone person, that means other than designated free zone, in respect of commercial property. Commercial property means which are used for business or business purpose. That property is treated as a commercial property. In that case, transaction between non-free zone person, it will be attached at 9%. Second category, transaction with any person in respect of non-commercial property. So non-commercial property means the property used for residential purpose, property used for hotel or any other business purpose, a hotel. In that cases, it will be treated as a non-commercial property. So that means it's not used for a business purpose. In that cases, it is treated as a non-commercial property. In that, very careful, it is any person. So if the property is situated in the designated free zone, even if you are situated in designated free zone, even if you are doing with the free zone person itself, it will be taxed at 9% because it is a non-commercial property. Why they are saying it's a non-commercial? So very careful. We can say that instead of that non-commercial, we can say that a residential property. But in a non-commercial, they have included the hotel business. Hotel business, we can, in a general terms, it is treated as a commercial property, hotel business. But in the non-commercial, they clearly mentioned that a hotel or residential purpose or accommodation purpose, all these things are treated as a non-commercial property. So let us look at the chart. So free zone person, here it is a taxable person. So first we will see immovable property in mainland. So one company is situated in a free zone, taxable person situated in a free zone. They have an immovable property in mainland. Then straight away it is taxed at 9%. Then second category, immovable property in free zone. So you have a property, which is situated in the free zone itself, and which is used for commercial property, which is a commercial property. And a commercial property, in that commercial property, you are transacting between the free zone person, then it is treated as a qualifying income. If it is a non-free zone person, that's why it's in the first previous slide itself clearly mentioned commercial property, non-free zone person. And non-commercial property, if it is a non-free zone person, commercial property, it's a non-free zone person, income taxable at 9%. And the second category, non-commercial property, it is taxable at, straight away, it is taxable at 9%. So commercial property means it is used exclusively for business or business activity, and not used as a place of residence or accommodation, including hotel, motel, bed and breakfast establishment, or service apartments like that. Next one is income earned from immovable property located outside of free zone. So if it is outside of free zone, then it is not eligible for qualifying activity. It is automatically treated as excluded activity. We have discussed in the previous slide. No, now it's what is the treatment for income earned from a commercial property located in free zone? So previous one we have just discussed a commercial property located in mainland. Now we'll discuss commercial property located in a free zone. There are two categories: commercial property located in a free zone with transaction with a transaction with a free zone person, then it will be taxed at a 0%. If it is with a transaction with a natural person or mainland company or foreign company, then it will be subject to 9%. Now, what is the treatment of income earned from commercial property located in a free zone with the following person? So, is relating to with the natural person. With a natural person, then commercial property with a mainland company, with a foreign company. Even if the commercial property is situated in a free zone, with a natural person, automatically charged at 9%, it's treated as an excluded category. If it is with a mainland company, again, it is automatically 9%. If it is with a foreign company, again, subject to 9%. If it is a mixed property, that's a commercial plus residential, in that case, they have to follow the transfer pricing documentation purpose, transfer pricing rules and regulations. So you have to maintain proper records relating to residential and commercial, then you have to bifurcate, then you can calculate that area. Now we look at a de minimis requirement. So de minimis requirement, one of the condition mentioned about it, mentioned about the sixth category. Out of one condition, it is relating to de minimis requirement. So de minimis requirement, it is either 5 million or does not exceed 5% of total revenue. So 5% of total revenue, whatever the total revenue. For example, you have a total revenue of 1 million, in that 1 million into 5%, or 5 million, whichever is less. Then if it is within that 5% of the range or 5 million, then still you will qualify as a qualifying free zone. In that purpose, for the purpose of calculation purpose, some of the revenues are excluded. That means you will not be considered for the purpose of total revenue. That is relating to revenue from a domestic or foreign P. So automatically that will be charged at 9%. Then property located in a free zone with a non-free zone person, or free zone with a non-commercial property. That means all this property, whatever it is attached at 9%, that will not be considered for the purpose of qualifying, for the purpose of calculating total revenue, in order to count 5% of total revenue. Then if de minimis requirements are met, then you will be eligible at a 0% CT. In that case, non-qualifying revenue means excluded activity. So you are conducting some excluded activity or non-qualifying activity with a non-free zone person. These are the category. It is saying that non-qualifying revenue. That means a simple thing. You can say that excluded activity plus other category. So other condition, it is like that non-qualifying revenue does not exceed de minimis. De minimis, it is like 5% or 5 million, and must maintain audited financial statement. This is the these are the two things recently they published in ministerial decision 55 and 139. And what are the conditions? If the free zone person failed to meet any above condition, then you are for subsequent tax period. That means that year plus next 4 subsequent tax period, you will be disqualified. That means you have to pay straight away 9% corporate tax. So other condition, non-qualifying revenue means excluded activity, whatever the revenue received from excluded activity. Then second category, transaction with a non-free zone person or non-qualifying activity. So excluded revenue, in that revenue from immovable property with the non-free zone with respect to commercial property, or any person, immovable property, not a commercial property. So this is, we have already discussed. So just for your reference, we are just creating one more slide to understand the concept very well. And excluded revenue from domestic PE or a foreign PE. That means straight away the excluded revenue category straight away charged at 9%. But the thing is that these excluded revenue are not included for the purpose of calculation of total revenue. That means a 5%, it will not be counted for this category. That means it's already 9% tax is applicable. Next one, can a qualifying benefit from 375,000 zero tax benefit in respect of income subject to 9%. So income subject to 9%, it is relating to branch income. Automatically it will be taxed at 9%, or foreign PE, it will be taxed at 9%. So in that case, you will not get a not deduction for zero tax branch and taxable at 9% from revenue from domestic permanent establishment or foreign P branch, basically branch. So branch, whatever the transaction happened, that will be taxed at, branch income will be taxed at 9%. Another category, a free zone person that is not a qualifying free zone person, will automatically, you will get a benefit of 375,000 zero tax ban. That means if you are situated in a DMCC, DMCC or DSO, then whatever the revenue generated in that free zone, you will not be treated as a qualifying free zone person because it's not situated in a designated free zone. So automatically you will get the whatever the benefit relating to deduction. So other point is some of the other FAQ. Qualifying free zone person, whether need to file ESR notification, it will come in future. It's some of the free zone, it is already there, notification, ESR notification, because you have to maintain adequate employees, then staff, then you have to incur expenditure. Then qualifying free zone maintain audited financial statement. So they must maintain audited financial statement. One of the condition mentioned in the qualifying free zone area, one condition is maintain of audited financial statement. Then whether qualifying free zone can become a member of the tax group. It is not possible to create a member of the tax group. Why they are not possible to create a member of the tax group? For example, company A is there, company B is there, you are creating a tax group, but company B is having a branch, then automatically 9% will be taxable. Or company B is transacting with another non-free zone person, automatically 9% will be taxable. Company A is a purely on qualifying activity. So in that situation, it's very difficult to create a tax group. So that's why it's not eligible for creating a tax group. For the one free zone person, be required to register. So you have a 0% corporate tax. So whether you need to register for to eligible for this one, you must register for corporate tax. We have already discussed the registration and everything in the first webinar series. In that one, we have clearly mentioned to whom to register and all these things. Second, fifth category, it is relating to OECD Pillar 2 globe minimum rules, globe rules. In that case, there is a BEP section 1 and BEP section 2.0. In that, there are two categories. One is subject to tax rate, and the second one is relating to globe minimum rule. In globe minimum rule, if it is an MNC company, if it is above 750 million euros during that financial year, then it will automatically be applicable for globe minimum rule. Globe minimum rule, it is a 15%. As of now, OECD prescribed rule 15%. As of now, the UAE has not yet released what's the percentage, but minimum rate is 50%. So in that case, whether it will be applicable for free zone, it will be applicable for free zone. Then foreign free zone person, whether it will be treated as a resident or non-resident. So resident entity means wherever the company registered in the respective free zone, it is treated as a resident person. In case of a branch, it is treated as a non-resident entity. These are the other FAQ relating to the free zone part. Now let us look at VAT consideration in the free zone. For the purpose of free zone, it is not relevant for VAT purpose treated at par with mainland. That means for the VAT consideration, free zone is not relevant. In a VAT, it is specifically says about designated free zone. So if it is a designated free zone, then only VAT will be important thing. So free zone, it will be will be discussed in detail. Then designated zone, only relevant for supply of goods. Supply of goods in designated zone are out of scope. So we'll see. One is relating to designated zone to designated zone. It is out of scope if supply is not consumed within designated zone. Then second category, designated zone to mainland. VAT will be applicable at 5%. Then designated zone to outside, it is out of scope. So this is basically, it is relating to goods. So in case of a VAT also, it's purely given if it is a goods you are transacting between the designated zone, it is a 0%. If it is on the mainland, it is a 5%. But relating to services, straight away, it will be taxable. That you already know these things, but just for a comparison purpose, we are just giving. So we'll compare with VAT and corporate tax. First scenario, from a designated zone to mainland, what will the VAT impact? So it is out of scope if ownership is transferred in designated zone. So if ownership transferred in designated zone, it's out of scope. Taxable if ownership transferred in a mainland. So if so, first one is out of scope if ownership is transferred designated zone itself. Even if you are supply of a goods from designated zone to mainland, but again returned back to designated zone, then it is out of scope. Otherwise, automatically it will be taxable at 5%. And in CT, corporate tax, it is some of the supply of goods. It is already mentioned in a qualifying income, and it will be treated as a qualifying activity. Second category, supply of a goods from designated zone to designated zone. You have a company in Jebel and you are transacting between designated zone. Then VAT impact will be out of scope if not consumed within designated zone, and CT will be treated as a qualifying income and treated as it is one of the qualifying activity. Then third one, supply of a goods from designated zone to outside UAE. So designated zone to outside UAE, VAT impact will be out of scope, and the CT impact will be treated as again qualifying income and qualifying activity. It is supply of a goods. Then next category, supply of service from designated zone to mainland, automatically taxable unless specifically 0% or exempt. Specifically mentioned, then only exempt, otherwise straight away it will be taxable. In CT treatment, depending on activity. Why this is a depending on activity? Because of some of the services like a reinsurance service, it will be purely on a service category. Insurance services, reinsurance services, then fund management services, ship owner management services, all these things. So that's why it's specifically depending on the activity. Then supply of service from a designated zone to designated zone, taxable unless specifically exempt, then depending on the activity. Supply of services from designated zone to outside UAE, automatically designated zone to outside UAE, 0% subject to certain condition, VAT impact depending on the activity. So cabinet decision number 55. So it's just a summary, whatever we have discussed about the 55. So qualifying free zone person, it is a qualifying income with qualifying activity. It is a taxable at a 0%. So what are the income from the free zone person, excluded activity, income from the non-free zone person from qualifying activity. Again, it is if you are transaction between non-free zone person, it must be a qualifying activity that are not excluded activity. Any other income subject to de minimis requirement, 5%. Then income incidental to first two category, that one will be, if all these conditions are satisfied, then again 6 conditions are there, then only you will be eligible for 0% tax rate. Non-qualifying income, it will straight away taxable at 9%. One is relating to income from domestic permanent establishment or foreign PE. That means a domestic permanent establishment for city purpose, it is treated as a branch. Branch income will be taxable at 9%. The second category, income from immovable property located in a free zone person, either from transaction with a non-free zone person for corporate non-free zone person for commercial property. That means you are interacting with a non-free zone person, or second transaction with any free zone for other than commercial property. So one is relating to commercial property, but that transaction with a non-free zone. Second one is relating to non-commercial property, but transaction with any person, either in a free zone person or non-free zone person. It will be taxable at 9%. Now, one example. ABC company is situated in a free zone in UAE. It has a branch in mainland in UAE. The total income of ABC LLC is 546,000 in tax year 2024, out of which the income from the branch is 146,000. What is the taxable amount and tax payable by ABC? So free zone person that has a branch in mainland, straight away qualifying income is 400,000. Branch income is 146,000. Then tax payable will be 13,140. So de minimis requirement branch revenue is not a part of total revenue for calculation of 5%. Second one, XYZ is a company located in a free zone. There is no other branch elsewhere, and the total income is 850,000, out of which 560,000 is related to business income in free zone, 150,000 related to principal business in mainland, 40,000 from interest in mainland, 80,000 from royalties in mainland, 20,000 from capital gains in mainland, and what will be the taxable amount and the tax payable by XYZ. So we'll see how it is a calculation. So total income is 850,000. Then we'll reduce income in the free zone 560,000. Interest income, royalty, capital gain. These are treated as a passive income. So still passive income will be 0%, treated as a 0% CT eligible. Then total it is coming like a 700,000. Then reduce 150,000. Tax payable at a 9%, 13,500. ABC company is located in a free zone in UAE, and it is a part of PQR group. So ABC company is located in a free zone. It is a part of PQR group, which is situated in a mainland in UAE. ABC transfers goods of AED 2.4 million to XYZ. XYZ, it is a subsidiary of PQR group in mainland. The cost of which is AED 2 million. So what is the tax payable by ABC? So there is a transaction ABC. ABC is not directly related to XYZ, but it is related to PQR group. So it's basically a group entity. So first category, what is the tax payable? It's a 0% because it's a group entity. You are transacting between the group entity. I have explained in the initial stage itself. And the second condition, what will be the payment of 2.4 million made by XYZ to ABC be deductible? So if you are doing any transaction between your group company, still you will qualify as a qualifying free zone with a 0% tax. But whatever the payment made by ABC company, XYZ to ABC company, that means a 2.4 million will be a disallowable expenditure in XYZ books. So in effect, what it says, ABC, you will get a 0% CT regime, but XYZ, whatever the transaction interact between ABC and XYZ, that will be disallowable expenditure in XYZ books. That means a 2.4 million into 9% straight away, it will be disallowed. We are just giving a short videos to just understand the next category.
UAE sourced income, non-resident, capital gain earned in a personal capacity, rental, legal persons
So
incorporated
just to see the
in
legal
UAE,
person status.
either in mainland or in free zones. Legal person incorporated outside UAE but effectively managed and controlled in UAE. Foreign legal entities with a P in UAE. Foreign legal entities earning UAE sourced income. Foreign legal entity with nexus in UAE. What income will be taxable? Taxable income derived from or outside UAE. Income is attributable to P in UAE income. Income is attributable to nexus in UAE, be subject to corporate tax. After ships in international exemption. Capital income.
So
Dividend from
what
resident
are the
juridical
exempt
person.
income?
Dividend from foreign juridical person subject to participating exemption. Capital gain subject to participating exemption. Income of foreign P subject to tax in a foreign jurisdiction.
So now we'll look at the example. For example, company is situated in a free zone and having a company B situated in a mainland company. Then there is a company A having a branch in mainland. Then company C, another overseas company. So let us see. So company A is set up in free zone. Then company A hold 100% shares in company B in a UAE mainland entity. And company C is a foreign entity. Company A has a branch in mainland UAE. Company A owns intellectual property. So company A owns intellectual property. So we'll see the different scenario, whatever the income received, what will be taxable. So one is a dividend from company B. Company B, it is a mainland company. What will be whether it is a qualifying activity? It is a qualifying activity. It is one of the qualifying activities relating to holding of shares and security. Then whether it is a qualifying, once it is a qualifying activity, automatically it will treat it as a qualifying income. Taxability, it is relating to exempt under Article 22. This is what just now I showed in the previous slide, the dividend income received from the mainland company. Very careful, it is from the mainland company. The second category, dividend from company C. Company C is situated in overseas. So whatever the dividend received, it will be treated as a qualifying activity, holding of shares and securities. Then whatever the income received, it will be treated as qualifying income. Taxability, it is still eligible for 0% CT. Interest income, it's a part of treasury and financing services to related parties. It is still qualifying as a qualifying income. Taxability, 0% corporate tax. Management income, it is still treated as headquarters services to related party, one of the activity mentioned in the qualifying activity. Then qualifying income, it's treated automatically treated as a qualifying activity. In that case, CT is a 0%. And royalty income, no ownership or royalty income, whether it is treated as a qualifying activity, no, it is treated as an excluded activity. It is clearly mentioned. Ownership or exploitation of intellectual property is an excluded activity. Then in that case, qualifying income, no. Then again, excluded activity within de minimis, then 0%. If it is exceeding de minimis, it will be taxed at 9%. And the profit of mainland branch, anyway, you have to consolidate with the holding company, branch company, because not having a separate legal entity, branch not having a separate legal entity. In that case, qualifying activity, it's a branch income profit. It's not a qualifying activity. It's not applicable straight away. It's straight away 9% CT will be applicable. Not to be included for calculating de minimis threshold that we have already explained in the previous things. So what are the key practical issue? One is a right nomenclature of expenditure. You have to clearly mention about what are the expenditure, then maintenance of documentation, agreement, invoices, emails and everything. Financial statements as per applicable standard, strong internal control system, then arm's length principle related to connected person and related party. And whatever the transaction between the related party and connected person, all these things you must document. So before going for a registration, first you understand whether do you have enough adequate staff to deal with the entire transaction, whether you have a qualified staff or asset, or whether you incurred qualified expenditure in that free zone. That means a core income generating activity you must be analyzed. Then whatever the transaction between the related party, you have to analyze whether within that de minimis requirement is satisfying. If it is not satisfying, even if you are situated in a qualifying free zone, automatically it will be charged at 9%. You will be disqualified for that year plus continuous 4 years. So these things, before going for a registration, you have to do a roadmap that what are the transaction ended between the qualifying free zone and non-qualifying free zone. And some of the clarification we are not received relating to the cross-border transaction. For example, a qualifying free zone situated and they are doing a without touching UAE, doing a cross-border transaction from China to UK, you are doing a sale or something like that. In that case, they are not released any FAQ relating to that part. Whenever we will get that information, we will update it in our website and other platforms. So next webinar, we are planning to conduct a related party, connected person, tax group, transfer pricing, and other related topics. And we will inform in advance relating to these matters. And we have first webinar, we have already issued 2 weeks before. And you can see the basic things like taxability, then place of establishment and all these things. And we have already released some short videos just for a 4 minutes to understand what exactly the taxability, resident person, then non-resident person, all these things. It is, you can check our YouTube channel, then you will get a full details relating to this one. We have some questions. One question, it's 375K free tax for a year. So 375K depending upon which free zone you are located. If it is a qualifying free zone and you are opting for your activity is within the qualifying activity, it will be, there is no point in a 375K, it will come. If you are doing an excluded activity not related to this one, or your de minimis requirement 5% is more than 5%, automatically 9% will be applicable. You will be disqualify as a free zone person. So you have given an application, you can have an option. That's why it's an initial stage itself. I clearly told that you have an option, elect either 9% or qualifying free zone. So if you opt as a qualifying free zone person, then whatever if you are conducting some excluded activity, automatically it will be charged at 9%. For example, you have a income, taxable income, it's around 1 million. In that 1 million into 9% will be the tax liability. You will not get 375 deduction. Another question, it is does entities in a free zone like a DMCC will be treated as the same as mainland companies under CT? So basically, designated free zone, it is same as a VAT concept mentioned in the CT law. So designated free zone, same as VAT concept. So automatically DMCC free zone. Why it is not applicable? Because you don't have any control relating to movement of people or movement of goods or movement of materials. So automatically, and one more thing, it's very careful. It is clearly mentioned about the material, goods or material, and the services category, purely some of the services only, like insurance, then fund management, then ship management, all these only service categories come. Rest of the things, even if, for example, you have a consultancy company, you are situated in a designated free zone, still you have to pay 9% corporate tax because it is not within the qualifying activity. So it's a DMCC free zone. It is just at par with mainland company that we have already discussed in the previous slide. Thank you for attending this webinar. Hope that you enjoyed this webinar session.